in 2 months now that you've cut estimates. Tell me about it.
Well, look, these are sobering times for banks. It's short-term earnings hell. This morning we reduced our bank estimates for the third time in 2 months, as you said. We have bank credit losses going up 2 to 3 times over 2 years. Net interest margins down at least a fourth. A recession is likely. We're now assuming a U-shaped recovery, not a V-shaped recovery. And our estimates are 1/3. That's 1/3 below consensus. So I don't think it's a spoiler alert to say expect banks to guide earnings lower by a lot in 2 weeks when they report results. And so these are tough times in the short term.
You still have overweight rating on Citigroup?
Yeah, look.
You still have overweight rating on Bank of America?
Absolutely.
You still have an overweight rating on
absolutely.
JP Morgan and Goldman Sachs?
Absolutely. Look, this is an earnings recession. This is not a balance sheet recession. It's night and day versus the global financial crisis. We're in this period, 13-day period, where banks are in what's called a blackout period. They can't talk to investors. Until JP Morgan reports results in a couple weeks, you're in this information void.
What do you mean? I mean, I was going to bring Kramer in right now. Kramer,
he doesn't like Wells Fargo.
Kramer had Mike Corbat on.
He doesn't have. He doesn't.
Wells
Fargo's not on his buy list.
So
Scott.
look, versus 2009.
Mayo can't talk Wells Fargo since he works for them.
No wonder.
Your silence said a lot.
By the way, I agree with Jim Cramer. Like, raising awareness of the issue helps prevent from the issue playing out. And versus 2009, the banking industry has $1 trillion more in capital, $2 trillion more in cash, $3 trillion more in deposits. And by the way, this is a striking number. The growth rate in loans in 1 week is a record, $250 billion. Wow. And that's why the article was written. But that doesn't, first, the growth in deposits is even more. So banks are doing what they are supposed to do. You take in deposits, you make loans. A lot of this is cautioned by borrowers who take out the loans and put it right into the deposits. And this does not go on forever. And here's the big number here. The response to the article is the level of cash or near cash in the banking industry is 10 times the level of unfunded corporate commitments. In other words, U.S. banks have cash and near cash of $4 trillion. Unfunded corporate commitments are $4 trillion. But you know what those drawdowns were in the global financial crisis? 1/10. So if it's like the global financial crisis, you have $4 trillion of cash for $400 billion of drawn down corporate commitments, or 10 times the level. So banks have the capital, banks have the liquidity, they can support the economy. And you know what else is really underappreciated, and this came through in Jim Cramer's interview with the CEO of Citigroup earlier, the operational resiliency of the banking industry. 160,000 people working remotely at Citigroup, 150,000 people working remotely at Bank of America, 98% of Goldman Sachs employees working remotely using secondary and tertiary operation centers. So it's not just the balance sheet resiliency, but it's also the operational resiliency. So when you get results in a couple weeks, you're going to say, yes, there were drawdowns. Yes, we're taking big charges. We have $20 billion of extra reserves for loan losses just in the first quarter for Citigroup, Bank of America, and JP Morgan alone. That's a big increase, and that's partly due to this accounting change known as CECL. But to the extent that the biggest banks can take much of their reserve builds for an entire recession in 1 quarter and still should grow book value for this year, that's a sign of resiliency. So not only will the banks weather this situation, but coming out on the other side, we think they'll be re-rated higher once investors and others realize that banks are now a pillar of strength and stability, which they were the exact opposite of for the global financial crisis.
Appreciate it very much.
Can I just say, and I didn't mean to joke,